Okay, welcome to, hoping this is working. Okay, so welcome to the financial analysis, and I hope that you can all see me and you can hear me. I've got my YouTube account set up next to me. This is my first time that I've been live on YouTube. So for those of you who are out there and you think, oh, you know what, Ted, I could do better than that. I do apologize. This is a learning curve for me as much as anything else. But hey, quite fun to kind of try all this new technology out. So without further ado, Shell, we're going to be talking about Shell, and over the next 15, maybe 20 minutes, I'm going to take you through the financial analysis of Shell's account and give you a flavor of what we might find out. Now, quick caveat. First of all, I'm not an expert on the oil and gas industry. There's going to be stuff popping up that I'm not going to be sure about. We're going to have to make assumptions, or we can go back and we can, do a little bit more homework and research. So all we're going to try and do is just to show you how much information, the kind of the process that I go through in terms of looking at Shell. Now, if there's anybody watching who says, Shell, Ted, I've never heard of Shell, which is quite possible, but I think highly unlikely. Shell is a British publicly traded multinational oil and gas company headquartered at Shell Centre in London, here in the United Kingdom. So I am here based in London. Shell's public company listed on the London Stock Exchange, and it's also on the Euronext. So you can actually trade. There are actually two classes of shares, A shares and B shares. I forget which way round it is, but make sure that if you're trading those shares or you're buying those shares, make sure you get the right ones, because some of them have they treat the dividends differently based on where they're listed. Anyway, so there is Shell for us. And what we're going to do is look at their financial statements. So let's pull up their financial statements for us. Here we go. So here we go. We are on page. Now you'll notice in the top left-hand corner, see if my screen, yep. So there we go. So you'll notice that we're on page 232 of 359. So this is a big old document, and everything that you find up here above, this is all about Shell, about what they do, their strategy, their environmental approach to planting trees to offset carbon emissions and all that kind of stuff. And you can read through that to your heart's content to find out who they are, what they do, what their strategy is, some of the key numbers, and you can also look at corporate governance, board of directors, etc., etc. We, for the purposes of this video, we're going to focus ourselves on the numbers. Now, I think you can chat with me if you are a subscriber to the channel and you can chat with me through the chat. So I'll try and keep an eye out in the chat and answer any questions as we go through, obviously, if I am able to answer those questions. So let's start off with the revenue. Here we are. We're looking at the income statement. This is the consolidated income statement. So this is all of the Shell companies all over the world, all consolidated into one. You'll notice up here it says in dollars millions, so we're dealing in dollars millions. So when we show the total revenue of 272, that's nearly 273,000 million, it's $272 billion. So that's a huge amount of money that they are generating in revenue. However, do compare it to the previous year, 2020. It was only $193 billion, and in 2019 it was 352. So if we assume that 2019 is kind of business as usual, pre-pandemic, and then of course the price of oil goes right down. You may remember the price of oil in 2020 went negative. That means that you actually had to pay people to take it off your hands. Sounds a little bit weird, I know. I think that was the West Texas. I think maybe somebody will correct me in the chat. That was the West Texas. So, you know, if you're producing oil like Shell and you're pumping it out of the ground, you got to put it somewhere. And if nobody's driving anywhere, then nobody needs the oil. And if nobody needs the oil, all of the places you can put it are full. And therefore, people are actually saying, yes, I can take that oil off your hands, but you're going to have to pay me. So slightly bizarre when we think here we are a couple of years later, and oil is wherever it is, somewhere around $100 a barrel last time I looked, but I'm again maybe a little bit out of date there. So 2020, and so what we see here is that Shell is very much a price taker. You know, the market sets the value of oil, and then if the value of oil is very high, Shell's going to make a lot of money, and if the value of oil is very low, Shell is going to lose a lot of money. So there is the revenue. We've got the next line is purchases. I'm not 100% sure what that is. So they'll be obviously doing a lot of their own manufacturing, their own production. So that's going to be the production. That's going to be the cost of, you know, getting the oil out of the ground. But it looks to me like that Shell also buys a lot of, you know, unrefined oil, and then will use that oil to refine in their oil refineries. So that'll be the purchases. So we could argue that those are kind of those purchases and the production and manufacturing. That's the cost of turning kind of, you know, really kind of heavy, thick, cruddy oil from the ground, refining it into the different types of oil that we actually need. So what we're seeing here is, you know, if we treat those two as the cost of sales, then effectively their cost of sales is 73% and their gross margin is about 27%. So that's basically saying for every dollar they sell, or so let's say $100, that $100 a barrel of oil is costing them $73. Okay, and that's quite an important number there. You can start to see that if the revenue goes down too much, then their overheads will remain constant and they'll make a loss. The next section down here, this is all the cost of running the business. Oops. So here we got the cost of running the business. So in here we've got sales and marketing, but we've also got some research and development, and you'll also notice there's some exploration, bit of exploration costs, looking for new oil fields. Biggest number though is this one here, depreciation. So the depreciation, depletion, and amortization. So Shell, lots and lots of assets, lots of oil rigs, and so their depreciation charge is absolutely massive. Look at it the previous year in 2020, 52 billion. Now that 52 billion will probably be, and again we can look at note 5 if we want to find out a little bit more about it. We'll probably find a lot of this number here was due to kind of writing down of, you know, of oil rigs. So you know what often happens, we have a kind of, you know, if a hiccup happens, bad news, we think, you know what, one bit of bad news, we'll just bury all the bad news in one go. So last year you'll notice that they made a loss of $22 billion. This year they've made a profit of $20 billion, a little bit up on 2019 of $16 billion. So interesting, a lot of conversation here in the UK about a windfall tax on the oil majors. You could argue, well, you know, they did make a big profit, but then the previous year they made a big loss. You'll also notice that they're paying already a fair amount of tax. So it's almost $10 billion in tax. And the last one to notice is this number here. This is their interest expense, which is the cost of the debt that they're using to finance themselves. So they are using, we're going to find some debt on the balance sheet because they have interest. So what do we see here? Bottom line, 7%. So for every dollar, every $100 of you know, barrel oil they sell for $100, they basically get to keep $7, which isn't a massive amount. It's better than last year when they were losing $12 on a $100 barrel of oil. So there is the income statement. What is it telling us? It's telling us that they're profitable. You know, they have returned to profit, and we should expect to see those profits, you know, continue for the foreseeable future, as long as we, you know, need you know, all of that you know, oil that they're digging out of the ground, and who knows, you know, the sort of move to renewables. Obviously these guys are investing in renewables, but their mainstay, their main business is around, you know, oil extraction, refining, and then selling, what we call so downstream operations, which is where they're selling, and upstream is where they are actually exploring and extracting, and Shell occupy both parts of that. Okay, let's go on to the balance sheet. Here is the balance sheet. So those of you who are regular viewers will know that when we look at a balance sheet, we are looking for the 5 key elements. So the first thing we see are the assets. So the assets we're splitting between the non-current assets, there they are, and then the current assets. So total assets for Shell, $404 billion. That's 276 billion of things that we need to run the business, and another 129 billion of things which are either cash or going to become cash soon. Okay, so let's look at just break that down. We've got the property, plant, and equipment. So that's the biggest number in their intangible, in their non-current assets. So that will be things like the plant, the rigs, the refinery plants, all that kind of stuff that they need to run the business. We can also see there's quite a lot of intangibles up at the top here. That intangible more than likely will be goodwill. So where Shell have expanded by buying other oil companies, they'll raise a little bit of goodwill. And then we mentioned earlier that this is a consolidated balance sheet. So if Shell own all of a company, it's in here, it's consolidated in. But if they only own 50%, they're going to show that 50% in here. And a lot of oil majors, they'll have joint ventures with other companies and associate companies where they own 40% or 30%, for example, and that will be reflected in that line there as an investment rather than on a consolidated basis. Quite interesting, this line, this next line, investments in securities. You don't often see that. So securities, these will be things like bonds, for example, multiple securities. That basically is just another name for cash. So that's where companies like Shell, they've got some cash and they've just stuck it in some securities in case they need to sell them and realize that cash a little bit later on. And then the rest of the items, we got a bit of deferred tax. I mean, I say a bit of deferred tax, it's $12 billion of deferred. So don't ask me about the exact sort of tax treatment, but obviously they're kind of like, they've got some tax, it's a tax refund, but they're not going to get it for a few years. That's really what we're looking at there. Retirement benefits, they got a benefit, a benefit accruing to them on the pension scheme. And then they got some trade and other receivables. Again, quite interesting. We don't often see this one sitting in the non-current assets, because that's kind of said, oh, you can pay me, but you don't have to pay me till next year or the year after. So usually that forms part of our current assets. So $276 billion of non-current assets, things we need to run the business, as opposed to current assets. They've got some inventory in there. That's 25 billion. So that's the kind of the oil in there, kind of, that they actually own. They'll have some trade and other receivable. This is oil that they've sold, but they haven't yet been paid for it. Then there's the cash of $37 billion. So cash, quite a lot of cash sitting on their balance sheet, $37 billion, really giving them a kind of confidence that they can carry on trading for the foreseeable future. Even end of 2020, they were sitting on about $32 billion. So very, very cash rich. You'll notice I've missed out derivative financial instruments. So $11 billion. We don't really need to know exactly what those are, but those are really hedging instruments. So often an oil company, what they will do is that they'll extract oil, and in order to guarantee that they're gonna make a market price, what they'll do is they'll buy oil futures or oil options, for example, to manage their exposure. And of course, these guys are dealing in dollars, but they may be extracting in euros or in pounds. Operations all over the world, and therefore they are subject to local foreign exchange reserve movements or foreign exchange currency movements, and therefore they will have hedging strategies in place in order to manage those, and that's effectively what those derivative financial instruments are for. So total assets, $404 billion. Scrolling down a little bit, we got the liabilities. So first of all, we see their current liabilities. We'll look at that bit. So that's this section here. These are the current liabilities. We'll include the kind of the assets held for sale as their current liabilities. So biggest number here, 63 billion. There it is. So this is what they owe to their suppliers. So this is either oil they've bought or their suppliers who they've been using and they haven't yet paid the bills. You'll also notice there's a little bit of debt here. That's absolutely fine. So, typically a company, if they've got debt, they'll have some of that debt will be maturing quite soon, and most of it will be maturing next year, the year after, and the year after. So we can see in the non-current liabilities, the biggest number is that kind of debt, which matures next year, the year after, and the year after, whereas the 8 billion of current liability is going to mature quite soon. And typically, a company like Shell, what they would do is they'd be looking to refinance that debt. So they're making an operating profit of about $33 billion. Their interest is about 3.6 billion. So I'm saying, look, you're earning 33 billion, your interest is 3.6. They can easily afford that debt. There's not a worry there. They're not going to do a Thomas Cook on us, for example. So Shell will be back in the market every single month saying, look, I've got some debt here. I need to refinance it. I need to borrow some money over here to repay the money over there. So that shouldn't really be a problem. And even so, from a liquidity point of view, $95 billion of liabilities. That's a lot. But if you remember their current assets, things that they own, which are either cash or going to become cash soon, is $129 billion. So from a liquidity point of view, and I'll just show you that just so we can see that. So from a liquidity point of view, this is what they own and have to pay soon, and this is what they owe and have to pay soon. So this is what 128 is what they own and they're going to receive in cash or have got cash soon. 95 billion is what they owe. So liquidity doesn't look a problem for these guys at all. So in terms of the long-term liabilities, biggest number is that debt, as we talked about, 80 billion. Next biggest number, quite interesting here, again, a little bit sort of funny for the oil and gas, decommissioning and other provisions. Okay, so this is the kind of, you have to understand the kind of the nature of the business here, that what they will do is they'll do a lot of oil exploration. We saw that. Sometimes they capitalize those exploration costs. And when they find an oil field and they say, right, we're going to drill it, what they do is that they set up their kind of their drilling platforms, etc., etc. But at the time that they set it up, they also need to set up a provision for the decommissioning. So they need to account for the fact that they're going to have to dismantle it. They can't, and you may remember Shell got into a little bit of trouble a while ago because they pulled a platform out to very, very deep sea and then sunk it. You're not allowed to do that anymore, obviously for environmental reasons. So they now realize that they're going to actually have to take those things apart and dismantle them and get rid of them in an environmentally friendly and safe way. So 25 billion or 26 billion of decommissioning costs, that's really what that number there represents. It's the kind of the cost we're going to have to pay at a point in the future in order to actually kind of extract and make good the area which we have been extracting oil from. So total liabilities, $22.9 billion. So if you've got a company with 404 billion of assets and 229 billion of liabilities, the difference is your net assets, which is your shareholders' funds of $175 billion. And that is this number down here. There's $175 billion. And the biggest number making up that 175 billion is retained earnings. So Shell have got $153 billion of retained earnings. So actually, quite an impressive company here. They've been making lots of profits, and those profits have been reinvested back into the business on behalf of the shareholders in order to grow the value of that business. You'll also notice there's a little bit that's called this non-controlling interest. Just as I mentioned, this is a consolidated account, and if they own 90% of the company, they'll consolidate it as if they own the whole lot. But then they will they'll show the other 10% as this minority interest. Now I've just noticed we got a question: if they own bonds and the yield changes, like for a 10-year bond, does the bond value change in the balance sheet next year? Yes, it does, absolutely. So what you will find is that they will be making, and actually that's a good question. So if we go back to the income statement, one of the things I missed out on is the bottom half of the income. So the bottom half of the income statement, which is this comprehensive income. So what you find is, if you look here, So it depends on whether they take it through the income statement. But typically, you'd expect, so the bonds, the investment securities, will be what we call mark to market. Okay, so they're not just held at cost; they're marked to market as the value goes up or down. So these guys will show a profit or a loss. Now, if you own a bond today and you pay, let's say, $100 for it, and then tomorrow it's worth $110, you haven't actually made a profit because it's an unrealized gain. And I'm guessing, and I do emphasize the word guessing here, that this movement in debt instruments remeasurements, I think that is what that line there relates to, or I may be wrong, and it may be one of the other lines. But what you're going to find in here is this kind of what we call unrealized gains and losses. So you've got a bond, you paid $100 for it. Today it's worth $110. That's an unrealized gain. And then next year it's worth only $90. That's an unrealized loss. You only recognize the loss or gain when you actually sell it, and then it goes into the income statement. So good question there. And that is kind of what's going on, which is why I tend not to kind of get overly drawn by this statement of comprehensive income. I'm much more interested in their trading account, the balance sheet, and the strength of that balance sheet. And then if we go down to the movement in equity, so what this movement in equity is doing is kind of reconciling the profit. So you remember these guys, they make a profit of 20 billion. That's the 2101. So remember that number there. In terms of what they can do with that profit, well, here's the retained earnings line that we were talking about earlier. They can either retain it in the business or they can give it back to the shareholders. And that 142 or 143 billion you see on the right hand side, that's the total amount of profit that, no worries, thank you very much, Laser Shark, for your comment. So that retained profit, that 143 billion, that's the total profit they've earned ever since they started trading at the beginning of the year, and the 153 is the end of the year. And so this next little section then kind of reconciles the two together. So we're focusing on this retained earnings number here. So that's this column here. And what we see up at the top, so there's the 142. That's the total profit that they've made ever since they started trading, but not yet given back to the shareholders at the beginning of the year, at the beginning of 2021. Then they make a profit of 20 billion. There's the profit figure. You can just see that I've circled, and that's from the income statement, so we can see that. And then what are they doing with that? Well, they're spending 6.3 billion on dividends. So they are giving back 6.3 of that 20 billion to the shareholders in the form of a dividend. And they are also buying back their own shares. Look at this, another 3.5 billion of share buybacks. Now, why does a company buy back its own shares? A number of different reasons. You could argue it's a way of giving back to the investors without tripping any tax liability. So if I get paid a dividend, I have to declare that dividend here in the UK and I get taxed on it. If my share value goes up, I don't have to declare it until I sell it. And therefore, it's good for me in tax planning to get capital gain rather than income. Okay, that's a kind of that's one argument. The other argument is that if you're the chief executive of Shell and you have lots of share options, if you pay out a dividend, you don't get any benefit of those share options. However, if you buy back your own shares, the value of Shell shares will go up in the market, and therefore your share options will become worth more. Now, obviously, you might say that's a very cynical view, but that's the reality of it. Anyway, so they're basically giving back almost six, there's nearly $10 billion. So basically about half of the profit is being given back to the shareholders in the combination of dividends and share buybacks. And that's why they finish the year on this 153. And that 153 will be carried forward to the next year. So you'll notice here they've done this for 3 years, and the way they set it out makes it a little bit more. But if you take the beginning of 2019, they had 183 billion. They made a profit of 15. They paid out dividends of 15. They did some more share backs. They finished with 172. 172 at the end of 2019 is the beginning of 2020. Then they have a comprehensive loss. They're still paying out dividends, a little bit of share buybacks, and they finish on 142. And 142 at the end of 2020 is the beginning of 2021. So what they should really do is kind of turn this upside down and have 2019 up at the top, and then it flows much better. But they want to show you this is this year, this was last year, and this was the year before that. So they kind of presented that. So you can follow that through reasonably easily. Okay, the last one is the cash flow. So here is the cash flow statement. Now, cash flow, absolutely vital for any company. If you're not generating cash, you're losing cash. And those of you who have watched a few of my videos will have seen examples of companies burning cash. And if you burn cash and you run out of cash, it's game over. You go back to your investors, and if your investors go, no, sling your hook, that's it, game over. So are they generating cash? That's the $1 million question. Here's the profit figure from their operations. They're trading before tax. And the answer is for these guys, yes, they are. Look at this. In fact, not only are they generating cash, they have been doing so even through the pandemic. So not as much, but Shell generating lots and lots of cash. Now, why are they generating all that cash? Well, the reason is this number up here. This is the depreciation and amortization. Depreciation and amortization, just so we know what depreciation is basically matching the cost of an asset to its useful economic life. Buying a table for $100, using it for 10 years is the equivalent of, that table costing you $10 a year. Now, that depreciation, that 26 billion, that is a non-cash expense. Okay, so it appears in the income statement. We saw it in the income statement, but it doesn't reduce your cash. And therefore, to turn an accounting profit, which has had the depreciation depreciated it from it, into a cash profit, which ignores that, we add back that depreciation. So these guys are generating a lot of cash, 45 billion. What are they doing with that cash? Well, Shell are investing. Look at this, $20 billion of investment. Okay, so 19, that's capex, that's tables and chairs, and that will be, a lot of that will be around environmental friendly kind of new projects and kind of moving away from oil and all that kind of stuff. So lots of investment, and there's also lots of proceeds. Okay, they're proceeds from the sale of property, plant, and equipment and businesses. Okay, so maybe they sold a bit of business they don't want to be in. They don't want this kind of dirty oil platform. They want new, I don't know. So, and that's part of their strategy. So the numbers aren't telling me what it is, but it tells me that, they are on a net basis, they are investing. Look at this. They're investing about $5 billion in the future. And in previous years, even bigger investment. So Shell is big investment. And you may remember, again, a comment, I think it was actually Bernard Looney from BP, who said that even if we pay a windfall tax, it won't affect our investment. These are part of their long-term strategic plans. They are investing in the future. And then finally, we've got the financing. So the financing is this last little section down here. And what we notice is, what are they doing? Well, they're generating lots of cash. Some of it's being paid out to the shareholders. A lot of it is being repaid to the people who've lent them money. So sometimes we see companies who are refinancing. There's an example of refinancing the previous year. They borrowed 23 billion to repay 17 and a bit billion. This year, borrowings are negligible and they're repaying 21 billion. We've generated lots of cash. We can pay down our debt. We don't want our debt to get too big. We don't want to do a Glencore. We don't want to do a Thomas Cook, for example. They're paying out the dividends. There's the dividends down the bottom here, and the repurchase of shares, as we discussed as well. So really, what are they doing with the money that they're generating? So the sum total here, we'll just clear this this annotation so we can see it nice and clearly. The sum total is they're making $45 billion in cash. They're investing about 5 billion. That leaves them with 40 billion left over, and there's another 35 billion that they are either repaying debt, 20 billion, or paying out to the shareholders in dividends and share repurchases, another 10 billion. Okay, and that means that they've got an extra 5 billion in cash during the year. And therefore, we can see that if we scroll down to the very bottom, they started the year with about 32 billion in cash on the balance sheet, and they finished the year with about 37 billion. 32 to 37, their cash has gone up by 5 billion, and that's basically what we are looking at there. So what's our conclusion from these guys? You know, they're profitable. EBITDA, they're trading at 22%, so that, you know, reasonable, pretty good margins. You know, they've turned the corner. Obviously, from 2020 was a kind of year we'd like to forget. They've got a lot of debt, but they don't have too much debt. They're able to afford that debt. The balance sheet is looking pretty strong. You know, they are a capital intensive business. They will have debt. We kind of, you know, just got to get used to that, I guess. But they don't look like they are excessively financed through debt. So, you know, we're looking at about, you know, 43% debt to 57% equity on the balance sheet, and they can afford it. So, you know, I don't think anybody's lying awake at night going, oh, I can't repay my debt. Liquidity, not a problem. They're generating cash. They've got a lot of liabilities, but they can easily pay those liabilities. So again, doesn't look like there are any issues around that. Pretty comfortable. Return on equity, 11%, is looking pretty good. And the cash flow is, again, looking very, very strong. So good, strong cash flow. I think that their investment looks a little bit light to me, I have to admit. And I did see that, you know, obviously there was a sale of a business in there, but I like to compare. Let me just reiterate this. So I quite like to compare the investment that they're making with their depreciation. So if you're depreciating assets of 27 billion and you're investing 19 billion, then you're not replacing them on a like-for-like basis, and that's a potential kind of red line for a contraction, for example. Now, you know, that's more of a trend analysis than anything else, and often we look at this number down here, this kind of this overall capex, because it looks like that they've sold, you know, as I said, some businesses as well as property, plant, and equipment. So it looks like their investment is not as strong as it might be, and that's just you know, maybe a little bit of a red flag. I mean, maybe an orange flag rather than a red flag. But in terms of the share valuation, and we'll finish on this kind of valuation. Let me just pull up the slide so we can see that. Here it is. So share valuation. This was yesterday's share price. 5 year. They kind of been bouncing around a little bit, so you can see the pandemic there, that, you know, everybody goes into shutdown and everyone goes, oh gosh, no one's going to need oil majors. So this is the kind of the tanking going on here, and basically every stock, as far as I can make out, all tanked down. And then everyone thought this was a buying opportunity, including Shell, and it went back up. And then they realized that actually the price of oil was going negative, and really we were locked down and everything was going south. And so Shell goes down in value, and then you suddenly think, well, hold on a sec, you know, I mean, we haven't closed the world is opening, you know, ships are shipping, and people are driving, and airplanes are now flying, and we're starting to see this share price go up, and actually, you know, that's a pretty substantial, you know, that's you know, a 150% increase from 1,000 up to 2,500. So or, you know, and so the market cap today stands at 170. Now, bear that in mind. First of all, if you have Shell worth 170 billion, the net asset value on the balance sheet, and I'll just pull this up just so that I can kind of really iterate this comment here. So if we look at the balance sheet, theoretically, if you were to take all of the assets of Shell and you sold them on eBay, for example, which would be quite difficult, but let's say you sold them all on eBay, you get 405 billion. That's this number here. And then you'd have to pay off the liabilities of 230 billion. That would leave you with 175 billion. So theoretically, you could today buy Shell for 170 billion in the market and then sell it on a breakup basis for 175 billion. Now, the reality is never quite that simple, but that's the theory. So what we're showing here is that actually Shell is trading at a discount to its net asset value. Now, most companies, they'll be trading at a premium, and the difference between the market cap and their net asset value is known as goodwill, okay, and that reflects the brand. And I'll give you an example. Coca-Cola, for example, trading on about 280 billion market cap, but they've only got about 20 billion or 30 billion of net asset value. So it's all the brand, it's all that goodwill. Whereas Shell, there's no goodwill in there, which I think is really, really interesting. Next thing I think is interesting is this PE ratio. Now, the PE ratio is the price to earnings. That's the price what you pay per share divided by the earnings per share. Or another way to look at it is the price of the company, 170 billion, divided by the earnings of the company, 20 billion. Now that works at about 8.5 times earnings. So I'm not sure exactly why there's a little difference. Maybe the numbers here have been updated more than mine. But the point is, we're in the same kind of ballpark. And if that doesn't quite make sense, turn it the other way around. Put the earnings on top of the price. Okay, if you were to pay 170 billion for something that earns you 20 billion a year, you'd be getting a yield of about 12%. Now, 12%, that's massive. So this looks cheap. Okay, Shell looks cheap. Now, there may be a reason that there's cheap. We don't like dirty oil. It's not on the ethical investing kind of, so if you're in an ethical investing fund, nobody's going to be buying Shell because it's dirty and it's horrible. Although Shell is trying to polish up its act and kind of, talk about, investing in, beyond hydrocarbons and electrics and solar panels and all that kind of stuff. Okay, but it just looks to me like it is cheap. So my kind of gut feel, and full disclosure, I am an investor in Shell. I bought Shell a while ago. My feeling about Shell is that, they're going to carry on making, and I may be wrong here. It may be that suddenly we all go electric, Shell is irrelevant, and the company just folds and dies overnight. But I kind of feel that even as we make this move from oil to kind of clean, Shell, they've got the resources to be able to do it. They're generating a lot of money from the dirty stuff, and they're using some of that, they're giving back to the shareholders, and some of that they are investing in the clean stuff and making sure that they are relevant going forward. So Shell they don't look expensive. Let's put it like that. I think there's more to run, and I forget exactly when I invested. I'd like to say that I invested around here. Probably the reality is that I didn't, but certainly it looks to me like, they do not look overvalued. Let's put it like that. So there we go. That is our analysis of Shell. That's that kind of, very quick. It took me a little bit longer than I expected, 36 minutes. So apologies if I've overrun my my stay. Thank you very much for watching. Thank you very much for we had a couple of comments in there. I hope you find that useful, and I look forward to seeing you. So do subscribe, like, share, subscribe to the channel, because that just helps me. You get notified, and looking forward to seeing you on the next live broadcast, whenever that will be.